الله الرحمن الرحيم. الصلاة والسلام على أشرف الأنبياء والمرسلين. Dear brothers, I don't see sisters here, but inshallah they will come. Assalamu alaikum wa rahmatullahi wa barakatuh. Thanks for joining us today. This is again an opportunity for us to meet again and exchange expertise and knowledge among each others. We are delighted today to receive Dr. Sami Sweden. Everybody knows Dr. Sami. He is the acting Director General for ERTI. In fact, the reason why we are meeting today is to revamp and relaunch again the COP on Islamic finance. Some of you maybe know that the Islamic Finance Committee of Practice was a long time been launched, and if you recall, some of you that the board in 2016 requested to convert the Committee of Practice to become a kind of flagship program, mainly not for all COP, mainly for Islamic Finance. The reason why, because at that time we have critical mass of activities and people and membership, and we found that it is wise now to revamp it again and relaunch it after the the reform and the new business model that occurred in the bank. So we are very delighted that Dr. Sami Sweden accepted really to take the leadership of relaunch again and revamp again this Committee of Practice. But without your contribution and without your participation, nothing can fly, and we need really your contribution. As you know, let me just say a few words about Committee of Practice. Committee of Practice, in fact, it's one of the tools we are using to exchange expertise and to exchange knowledge among experts. Basically, in many other MDBs, the Committee of Practice, they have many. Like they can, it is created on voluntary basis. Until it takes certain maturity, we can later on take it to another level of institution. But Committee of Practice, as you saw, for example, we have six main Committee of Practice. We have one on SDG, very active, where Dr. Rami is the leader of it, and we have many members among this. We have a Committee of Practice about halal industry, which need also to be again revamped and launched. We have another one about infrastructure. We have about agriculture and so on. So Islamic finance, we think that it is one of the most important Committee of Practice, because when we talk about Islamic finance, it's supposed to be cross-cutting among all lines of business in IDB. Whatever we do as institution today it is related to Islamic finance. So again, this Committee of Practice is a platform for all experts, internal and external potentially, and it's a way also to bring people from within the world to come and exchange their knowledge and leverage from their experience in this field. I don't want to say too much more, but we as a knowledge management and institutional learning, we are facilitating the activities of those Committee of Practices, and we will be more than happy to relaunch again this Committee of Practice about Islamic Finance with Dr. Sami Sweden. We will be sending you a registration form, for which you can just show your interest to join as a member to this Committee of Practice, so you can discuss the plan for the different activities and event and a workshop you would like to conduct for this year and next year potentially. So just be stand by about an email that we will be sending to all to show your interest to join this. But again, this is on a voluntary basis. We are working with the DUS team to make this more institutionalized. They will be, and we are trying to put kind of KPIs by next year, inshallah. So people, when they participate in such platform, there will be kind of appreciations and kind of it will be part of their daily activities. But for the time being, we thought that it is wise to open it as voluntary. So whoever wants to be participating, because this is where people, they can solve problems, they can share their challenges, and they can discuss among the different experts in the institutions. Without delay, I will pass also the mic to Brother Salman, who also delighted us to join this Committee of Practice as one of the members working with Dr. Sami, and to say a few words about this Committee of Practice. Thank you so much.
Thank you. Assalamu alaikum wa rahmatullahi wa barakatuh. I think I'm honored to be part of this community, and the community is by the community. I will speak about three things, and before I speak about those three things, I would like Brother Hilal also to join me, because he's also our partner in that. Two of us are together in the revival of the COB for Islamic Finance. There are three main questions for this. That why Islamic finance is important. I think it is in order to provide socio-economic development to the member countries, we are focusing on Islamic finance. It can work. And it can provide a transformation towards an Islamic financial system, which is more stable, just, and benevolent. So the whole purpose is this. But what to do to implement these things is that we have to start with our operation, we have to start with our bank itself, and we have to start a Islamic finance thinking. And all of us are trying to do that, but how to create that culture and how to solve the problem. So community of practice is one of the hows, one of the ways, among many other ways. So this is basically, we will try to facilitate certain lectures, courses, dialogues, question and answers, etc. And the community is open to the idea, because the membership is free, and people can join and they can provide the ideas, and the KMI will manage all these things. Community of practice, as mentioned, not in Islamic finance but in other things, but it's also available in other MDBs. And I remember in one of the ISDB global forums that took place in Jeddah a few years ago. At that time, we invited Dr. Zamir Iqbal to give a lecture. He was not part of IDB at that time on community of practices. So we would like to get the experiences of the people who have participated in those community of practices to guide us, and to all of you to join and generate ideas and share ideas. So with this, I just conclude and pass on the mic to Dr.
You want to say a few words, Dr. Hilal? Okay, Dr. Sami, the floor is yours. Shall we go on the other side? Go on the right.
السلام عليكم ورحمة الله. بسم الله الرحمن الرحيم. الحمد لله والصلاة والسلام على رسول الله وعلى آله وصحبه. First of all, I thank Brother Warif and the Knowledge Department for stimulating the team and the group to re-energize the community of practice. I think it's a very good opportunity for people to learn, interact, and develop ideas away from the formalities and bureaucracies. Thanks also to Brother Salman and Hilal, who are leading the community of practice for Islamic finance. I'm honored today to talk about benchmark for pricing Islamic credit instruments, or as usually known, alternative to LIBOR, because LIBOR is the most famous indicator or index for interest. And in the Islamic finance industry, this was one of the major issues for decades. In IRTI itself, it has been on and on for, I think, for decades it was there, and many paper discussions were raised. The reason now it was developed, or the issue came back again, is that LIBOR will officially cease by the end of 2021. That is the decision of the financial regulators in the UK. LIBOR it means London Interbank Offered Rate. It's the rate at which banks are willing to borrow. What is the rate that the bank is? Interbank, it's between banks. It's not for retail or corporate or government, it's interbank. There was a scandal, famous scandal, if you search LIBOR scandal, that those banks who report their rates were actually manipulating these rates in order to give an inaccurate perception of their creditworthiness. If I tell you I'm willing to borrow at 3% instead of 4%, I'm telling you I'm more creditworthy, I'm less risky, and this would have huge impact on more than 300 trillion derivatives pegged or linked to the LIBOR. So after the scandal, it was reorganized. Instead of the British Bankers Association that was managing the process of LIBOR, it was transferred to Intercontinental Exchange under the Supervisory or Finance Conduct Authority in the UK. And the FCA decided that for at least two reasons. One, loss of interest or trust, actually, and the decline in interbank market. The interbank market became so slow and low in activity, mostly because of lack of trust. Banks, they don't trust each other, so they don't lend each other as before. So because of lack of activity, the data coming out from these activities is not reliable anymore. So they decided to end LIBOR, and then banks, they have to find alternatives. They are already searching here and there what could be an alternative index. Now, from an Islamic point of view, this is very important, not only because LIBOR will end or not, it is conceptually how can we price credit transaction. If I can sell this commodity today at 10 riyals, let's say, if I want to sell this commodity for a price in 1 year's time, what would be the markup? How to calculate this markup? We need just a framework, at least, to think about how to calculate that markup. So what we need a benchmark for pricing Islamic credit transaction or Islamic credit contracts that can be used by anyone who is involved in Islam, not only banks, anyone who is selling on credit or dealing with credit, they can benefit from that benchmark. Whether institutions, central banks, businesses, individuals. Now, what are the ideal properties or desirable properties? First of all, this benchmark has to be independent from interest. You cannot give me a benchmark that is actually embedded in it is LIBOR. This will be circular. We will come to that. It has to have sound economic rationale, forward-looking, decentralized, transparent, verifiable, simple, easy to produce. Now, if that's too much, let's add two more. Widely accepted and could have, in principle at least, help avoid or mitigate the financial crisis. That might seem too much, but it is not actually. It is realistic. We will get to that. So, first of all, independence. Many people proposed, let's use the rate of return on investment accounts in Islamic banks as a benchmark instead of using LIBOR or interest. But then how this return is generated? It is generated based on murabaha transactions. The bank is financing clients. And these murabaha transactions are benchmarked on LIBOR or whatever interest indicator. So it's circular. It's not independent from interest. Same thing if you say, let's use sukuk yield or sukuk rate of return. Well, again, if you go back to the contract of sukuk, you will find there clearly saying LIBOR or whatever interest index. So we have to be careful that whatever benchmark we are proposing, it has to be independent from interest. It's not that we just go into sell. It is simple. From the investor's point of view or from the financier's point of view, there are at least two things he has to, or he or she, have to take care of. First of all, you want to preserve the real value of capital. Second, you want to have a return in line with the market. So the minimum is to preserve the real value, which means you have to protect have to compensate for inflation, or more accurately, expected inflation, because you will get your money later. So you don't, it's inflation now is not exactly what's inflation in 1 year's time, so it's about expected inflation. So you have to be sure that what you are accounting for is expected inflation. And for the real return, you want something that reflects the market or the economic conditions. If you pick up textbooks on economics, you will find how interest actually is defined. It is simply cost of real capital plus expected inflation. We tend to think that interest is something fundamental. It's not. Interest itself is defined in terms of economic variables. And these economic variables are, as you can see, it's the real cost of capital or the cost of real capital plus expected inflation. So how to calculate expected inflation? There are many ways, of course, to calculate expected inflation. There are surveys, which means you survey so many people in various sectors. What do you expect the price would be in 1 month time, 3 months time, 6 months, and so on? From that, you calculate what would be the expected inflation. Or you can do fancy things and using time series, using term structure of interest rate, using Phillips curve, modeling structural models, TIPS, which is treasury, inflation protected securities. Now, guess what? Overall, the best are surveys. Overall, not always, but the studies that compare different ways to calculate expected inflation, they come up with this result, that in general and overall, the most accurate way are surveys. And the worst overall is interest. Interest is not the best predictor of expected inflation, okay? Now, there are many surveys, as far as I can tell. I'm sure there are more over time, maybe more surveys have been developing. There are surveys for the US dollar or the US, surveys the Euro area. Economist magazine, every 2 weeks they publish forecasts of expected inflation on various currencies. But these are limited in terms of frequency, they are limited in terms of currencies and so on. So we need something more systematic and more frequent to get the expected inflation that we are looking for, in order to use it as a benchmark. Now, how to calculate cost of real capital? Now, this is a more complicated thing. If you go to finance, you will find many ways to calculate cost of capital. You will find CAPM, weighted average cost of capital, arbitrage pricing theory, etc., etc., etc. But if you dig into these models, you will find interest sitting there. In all of these models of cost of capital, interest is there. So we end up with the same problem of circularity. Because those who developed this cost of capital model, their objective was not to find something independent from interest. That was not their objective. Their objective was to calculate the overall cost of capital. And obviously, if it is overall, you must have interest somewhere sitting there. And you cannot take it out. If you take it out, the whole thing will collapse. There are other ways to calculate, let's say, the real capital. For example, rental rate. If you calculate the average rental rate for equipment, for real estate, and so on, that's another indicator that would help, give an indicator of the cost of capital. You could say, how about growth rate, GDP growth rate, which gives you a view of the overall rate of return in the economy. The growth rate is the most diversified rate of return in the economy, which is the whole economy, how much the economy is growing. And I'm sure there are surveys, but I'm not sure what are these surveys and how accurate and how frequent they are. So I cannot tell now if there are surveys of course, all those survey forecasters, they will tell you what do they think the GDP growth would be in, let's say, 6 months or 1 year or so. But I'm not sure if it is the same as the expected inflation survey. Now, how about central banks? How would central banks set the interest rate? The most important interest rate in the economy is central bank's interest rate. And how should the central bank set the interest rate? Just a quick background. In monetary policy, there are two approaches. Either you have rules or you have discretion. Either you are Keynesian or you are monetarist. Either you follow a fixed rule and you say I will not play, I will just follow these rules in order to develop or protect the credibility of the authorities. Or you would say, no, I have to be active. And when there is a recession, I have to do this. Now, there are two kinds of rules. Money supply rule, that was famously supported by Friedman, and it's not valid anymore, by the way. Or you can have an interest rate rule. So you have a rule governing how the central bank would set the interest rate. This is more realistic, and that's what we are focusing. That's what we will be focusing on. The most common of these is Taylor's rule. John Taylor is a professor of economics in Stanford University, and he developed this, I think, in the 70s or something. But it is established interest rate rule for central banks. It's well known. Central banks might or might not follow this rule, but it is well established. And what is this rule? It's exactly the same definition of interest. It says the interest of the central bank should be set to, first element, you have R star, which is long-run growth of the GDP. At the time when he published, it was about 2% for the US economy. Plus expected inflation, plus a policy component. The policy component says if the target growth of GDP if the actual growth of GDP is higher than the target, for example, then you have to raise interest in order to slow down. If the other way around, you reduce interest, and so on. So there is a policy component for the GDP and for expected inflation. If expected inflation is high or actual inflation is higher than target, then you need to raise the interest. If the actual inflation is less than expected, then you reduce them, and so on. This is the policy component. So from our point of view, the first two components are the most relevant for us, which is the growth rate of the economy, the growth rate of the real economy, plus expected inflation. Now, is this a valid rule? Well, after the crisis, John Taylor published a report, or wrote a paper, saying how things would have came about if the Federal Reserve followed Taylor's rule, rather than whatever was done by Alan Greenspan at the time. So this is actual data. This straight line, or this black line, is the actual data on the boom and bust in the housing sector. The dashed line, this line, is the model that he estimated. He estimated a model. He tried to, model this boom and bust in the housing sector. So you can see that the model is reasonably tracks the actual, not 100% of course, but it is quite reasonable. Now, if you take this model uses the actual interest rate, the one that Alan Greenspan actually set in 2005, 6, and 7, and 8. Now, if you feed the interest rate based on Taylor rule, you will get this. So this is counterfactual. That's a simulation. First of all, you fit the model and you try to be sure the model reasonably well track the reality, and then you say, okay, let me plug in alternatives. This is not 100% sure that it is true, but at least it gives an indication how things could have been done. So you can see that if Taylor rule was used or followed by the Federal Reserve, at least there was a very good chance that we would not have that crisis, at least that magnitude, of that magnitude. This is another graph. It shows across countries. These are different countries. Okay? Italy, Netherlands, France, Germany, and so on. These are various countries, okay? The x-axis here, you have the deviation from Taylor rule. How far is the central bank interest rate deviates from Taylor rule. And then on the y-axis, you have how much money is flowing into the housing sector. So he's saying the more central banks rates were deviated from Taylor rule, the more there was a boom, and therefore the more likely you have, harder crash after. So he's trying to tell us, if you followed Taylor rule, if you followed my rule, then you would have been in a better shape rather than. And this is from the Economist magazine, of course. They had a report on this. So now we have a formula that is well established in the literature. It's widely accepted. Everyone, in general, it's widely accepted. No one would question that interest would be had a real growth component and expected inflation component. Independent of interest. This formula doesn't have interest on the right-hand side. This R star is the growth rate of GDP, long-run growth GDP. So there is no interest here on the right-hand side. Interest is defined in terms of economic variables. So the definition is independent of interest rate, widely accepted, and could have helped at least to mitigate the risk of the crisis. Another way to look at it is that nominal output, which is the GDP, the economy in nominal terms, which means in current prices, is simply price times quantity. Now, if you take the logarithm of this formula, and then take the first difference, you end up with growth rate. Now, all you have to do is just do the expectations, and you end up with basically the expected growth in output would be the expected inflation plus the expected growth rate in the real economy. So, which is basically the same thing. So that's another way just to look at it. You end up with the same thing. No matter how you look at it, you end up with the same thing. Now, if we follow something like Taylor rule, then you might ask, shall we follow LIBOR or shall we follow this Taylor benchmark? Which one we should follow? Now, this is supposed to be only a benchmark. So the bank or the financier can set whatever price they like. It's up to them. But they have at least to be aware of what is the problem. For example, in many cases, banks were lending at, let's say, a rate of 3%, while actual inflation was 5%. So shareholders, the owners of the bank, were actually losing in terms of real value. That's fine. If they want to lose, it's up to them. Up to a certain limit, of course. But they must be aware that they are losing in terms of real value. That's the point. They have to be aware that, look, you are lending at 3% or 2%, expected inflation is 5%. If you are happy with that, it's up to you. It's a free market. You want to do whatever you want, but you have to be aware that you are losing on the real value. Obviously, no rational investor would accept to lose real value, at least systematically. They might accept to lose in the short run, and then later on they will adjust their rates to preserve the real value of their capital. So the expected inflation is very important. It will actually be the benchmark that lenders, they will gravitate towards because they want to protect the real value of their capital. The other component is the growth rate. If you are expecting the economy to grow at a real rate of 3% and your real rate of return is only 1%, you are losing. The market is growing or the economy is growing at 3% and your net or real return is only 1%. Why is that? There's no reason for that. Again, if the lender wants to lose money, it's up to the lender. That's not there is no restriction. But the investors or financiers, they must be aware of these things. So here's the point. This benchmark will actually, other indicators will gravitate or converge toward this benchmark. It is not the other way around. One would say, how could I have two benchmarks? Well, one of them is the most fundamental. One is the fundamental rate or benchmark. The other would be fluctuating, but then ultimately it has to converge because people cannot systematically lose money for a long time. They have to ultimately recover their real value of capital, and they have to catch up with the market. So interest indicators will converge in the long run or in the medium run to the benchmark component. Now, what to do? How to convert these concepts into an action plan? It seems it's very simple to state, but not very simple to implement. Conduct regular surveys of various sectors of the economy on two things, prices and quantities. So if you have a regular surveys on prices, you can calculate expected inflation. If you have regular surveys on quantities, you can calculate expected real growth of the economy, or growth of the real economy. For example, consumer prices, producer prices, rent, and so on. These are on the price side. So we conduct a survey asking people, what do you expect the price of oil to be in 1 month, 6 months, 12 months? What do you expect the price of rice to be in, and so on? From these expectations, it's straightforward to calculate the expected inflation. And for expected quantities, how much do you expect, how many barrels of oil you expect we sell next month, 6 months, and so on. Quantity, this will be quantity. How many kilos you expect to sell of X commodity, and so on. So these are quantity variables. So you make a survey on what do you expect the quantities would be in 1 month, 6 months. Now for us, this might be strange, but if you ask anyone in the real economy, in the market, they can give you reasonable estimates. What do they expect? How much volume? What's the volume of their commodities and goods that would be sold within the coming few months? So this is something the market is aware of, and it's not very difficult. The only thing is that how to collect this data. And this will take us to the technology parts, which we have the experts here, mashallah, is that we can use the blockchain technology in order to conduct the surveys, collect the data, verify the data, and then publish it. One of the reasons of the LIBOR scandal was that because you have only a limited number of banks reporting, and no one is verifying this reporting, then those banks, they have every incentive to report false numbers in order to make money. I mean, there are billions at stake. It's not something you can easily control. But if we develop a technology, a strategy that is transparent, verifiable, then at least the chances would be much, much less for fraud. I mean, we are not saying it will be 100% fraud-free, but at least you have a systematic approach to verify, validate these data. And of course, you will have networks, you have to validate the identities of the participant, you have to be sure that who is participating in this network, who is providing the expectations, and so on. You could have kind of incentives for people to participate. For example, you issue coins, and then these coins can be used to buy from groceries and so on. So you can have an incentive system, so those people who are participating, they would keep participating. Now, it's very, as we said before, this is a benchmark. If you are a bank, then this is not a pricing formula. Okay, you don't say, okay, the expected growth is X, expected inflation is Y, that means my price must be X plus Y. You will set your price according to your own views. But this benchmark will tell you how far you are from what you should be taking into consideration. So if expected inflation is 2 or 3%, and you are financing at 2%, maybe you say, okay, I want to cut the price. I want to beat the competition. I want to do this. So market conditions will fluctuate. It will be different for different players in different circumstances. But this will be a benchmark. So it is not a pricing formula. This is a benchmark. They say, okay, if the economy is growing at 3%, am I catching up? or am I losing? Am I behind or am I ahead? So you will have your own pricing strategy. You will have your own pricing formula, but this will give you an indication how far you are from the fundamentals, which is the real economy and the expected inflation. Now, when banks actually price their product, and you take the average of that price, then we can call it a reference rate. That would be a reference rate. This is not very useful, because simply to take the average is just the average. It doesn't give you a benchmark according to which you evaluate your pricing strategy. This is just a benchmark of what others are doing, but doesn't give you a direction where to go. Okay, so this benchmark, which is based on the expected growth of the real economy plus the expected inflation, is independent from interest. It's sound economic rationale. It's forward-looking, because you are surveying expected change, whether in prices or the economy. While LIBOR now is based on, ideally, the best thing is that it is based on actual transaction. If you are taking the last transaction that IDB or any other bank charged customer X, this actual transaction is backward-looking, because it's a history. It's history. It doesn't tell you what is the expected change in the future. It just tells you what happened at a certain date in the past. But that's not what we are looking for. That means we have to have another way to calculate from this actual data what is the expected change. That means we have to have another strategy to find out how to predict the future. While we already know it's a matter of fact now, experimental fact, is that surveys are more accurate in general, overall, not always, but in general they are more, at least they are reasonably accurate. So you end up with, you hit two birds with one stone. It's more accurate and it's forward-looking from day one. You don't take actual data and then, what does that mean for the future? These two steps. You have one step. Once you have the survey, you have one step. Decentralized, transparent, verifiable, simple, and easy to produce. Well, simple in terms of you are just collecting expectations, and then you are simply averaging the expectations and calculating whatever you want. But I'm not saying that developing the network is simple. Developing the network is not simple. And it could contribute to financial stability. Thank you very much.
We take 3 questions at a time, and then we'll also respond and then again 6.
Thank you very much, Dr. Sami. It's really interesting how you took us back to the drawing board on calculating this interest rate, this reference rate. I'm sorry, it's not me saying interest rate. Now, there are a couple of things that, since you have taken this matter with reference to the US market, so most of these surveys are already there. So say, for example, if I want to know the expectation about the production, so I can go to the wholesale survey.
These are the top results.
Oh, sorry, I don't know. So the wholesale market, I can take the manufacturing survey, I can take the wholesale market survey, so I can get good information about what the orders are for the wholesalers, what are the orders are for the manufacturing. So we can go with that one. Has anyone, or have you done that kind of looking back approach on those data and see, say, for example, 2004, beginning of 2004, in sample analysis and then out of sample analysis to see how this reference rate is closer to the actual rate that should have been in the market. So this is like something which is very simple to me, like in terms of the application. So maybe if we could get that out of sample analysis from the historical data, maybe we are better able to say that, look, this is the rate and this is how it has worked and this is the benefit of this rate, that we would have avoided the financial crisis of 2007, 2009, and so on and so forth. And especially like these days when we are hoping for a new crisis. So if we could say something more in line with that one, so maybe that will be more useful as well. Thank you.
Very interesting. Thank you very much.
Thank you very much. My
You can
question
introduce
is,
yourself first of all, and then
my question is, just to help me with my understanding, does it mean that the Taylor rule is something that one can start with to make it more Sharia compliant, to be more methodological, just for my understanding? Thank you.
Thank you.
Thank you, Brother Dr. Sami. Thank you. Very interesting lecture.
Can you, Dr. Abdulhamid, use the mic to introduce yourself?
I'm
and,
using it. Okay, my name is Abdulhamid Bashir. Be closer. Be closer. Okay, thank you very much. I think it's very interesting. So it's just like a kind of a lecture, classroom lecture. So people have to take notes. Thank you really much, actually.
It's boring. It was boring.
No, it's it takes us back again to school. And, my question is, thank you, brother. This question is actually, first of all, you talk about surveys and all this. I think the model is fine, but I'm just, not sure or not, confident or not, comfortable about the surveys, because you said you have to survey people. Okay. First of all, who are the people who have to be surveyed? The second thing is, what kind of quantities that they are looking for? So the market, the GDP has a lot of quantities. So whom are you going to? The second, or the third thing, maybe how costly is this survey and how long it takes actually to come with this. Thank you.
Shall I answer? Okay, Brother Dawood made a very good point. He said there are already surveys on producers, orders and so on, which is very good. I was not aware that, I was aware that there are surveys, but I wasn't sure about the details. So that would be a very good project if we go back to these orders, or from there, are these, I assume for expected orders, right? So it's expected quantity. So that would be a very good project to see whether that would, I think the only problem would be the frequency. I think that was the most, because the same problem with the expected inflation. The frequency isn't, the data are not frequent enough to make reliable calculations within a short period. Maybe for a long period of time, it will make sense. But for a short period of time, I'm not sure. So there are surveys. This confirms that these surveys are valuable, are important, are necessary, and we only need to upgrade the technology, the frequency, and so on. But that would be a very interesting project, is to go back to the surveys, and from there, I'm sure someone must have talked about this, but that would be a very good project. Is Taylor rule Sharia compliant? That's a good question. Well, anything is halal unless Sharia says it is not. So we don't have to ask, is this microphone Sharia compliant? Is this mobile Sharia compliant? It's the other way around. Is there anything in Sharia that says we cannot use this? Otherwise, al-asl al-mu'amalat al-hal, which means all transactions when it comes to daily, social, economic transactions, all are acceptable unless there is something wrong with these transactions. So we don't have to say, or even to ask, is Taylor rule Sharia compliant? That would be, Taylor would have never thought about this. But it's very simple. Is Taylor rule dependent on interest? And the answer is no. Well, as far as we can tell, Taylor rule does not depend on interest. It defines interest in terms of economic variables, and these economic variables are Sharia compliant by nature. We don't have to have a stamp for that particular. And I think we should have this approach in every issue. We don't have to have a stamp of Sharia compliance for each and every transaction. It's the other way around. Same thing when it comes to cryptocurrencies and these things. Is blockchain Sharia compliant? Is Bitcoin Sharia compliant? Is Ethereum Sharia compliant? This will take us nowhere. It will make our life extremely difficult. It's the other way around. Is there anything wrong with Bitcoin? Is there anything wrong with blockchain? If there is anything wrong, then we have to identify what's wrong with that. Otherwise, Sharia would say you can يحل لهم الطيبات ويحرم عليهم الخبائث. يحل لهم الطيبات ويحرم عليهم الخبائث. Anything that is good and useful is Sharia compliant. Anything that is harmful is not Sharia compliant. Who and what? That's a very good question, Dr. Abdul Hamid. There are, I can refer you to these studies, okay, on the expected inflation, on the other surveys. There are so many. It has been for decades, by the way. It's not something recent. This has been on for quite some time. Those who are working on structural models, they do get these data. Those people who are, St. Louis model and all these things, they get these nitty-gritty data and they use it. But I'm not sure how, and these models are very complicated, and they are not fancy anymore after, in the 90s and later on, they became less popular. We don't have to survey each and every commodity. Just like consumer price index, it's a basket of commodities. It's not every and each commodity in the consumer's market that you have to put in it. No, you take a representative basket. Same thing, you don't have to have everything. We just take a sample, a representative sample, in as much as possible. It will never be perfect. It will never be perfect, but it will help us a lot to develop in that area.
Just telling me that, for instance, if you are looking for the housing prices, maybe you can take survey the housing, for instance. So in that case, we have many indicators or many.
There will be many indicators. I mean, for example, the consumer price index or the producer price index, you select what are the commodities or goods that would be involved. Same thing here. If you want to develop an index of expected inflation, then you have a set of goods and services that you would use for conducting a survey. Okay?
My question is, you are saying that LIBOR will cease by 2021. Then what they are thinking about the alternative in their place? And whether the alternative they are thinking about is somehow related to the Taylor rule or it is related to something else?
Shall I answer? Let's take two more.
Assalamu alaikum. My name is Kenan Yusufovich from PPP division. Thank you, Dr. Sami, very much for the presentation. I have a question that, for example, if I am a long-term financier and I decide to take Taylor benchmark as my benchmark, the first question, and I'm sorry if I'm dividing it in a few questions. The first one, am I adjusting expected GDP growth rate and expected inflation annually, or I take for the duration of my long-term financing? And second, if I'm looking at different markets, specifically every country will have different Taylor benchmark. And countries that have a larger Taylor benchmark or larger number means that they are expecting larger growth. And those countries are usually emerging economies. And emerging economies by default attract a lot of liquidity from global investors. And with more liquidity, there's more supply, and prices tend to go downwards. So how actually am I going to be different from other conventional investors that take different benchmark into their consideration? And how, at the end of the day, am I going to be competitive against conventional investors?
Thank you for the presentation. My name is Juan Damir. My question is, if you looked at today's Islamic Finance, right, you would notice, and even from the name of your slide, we call it credit instruments, right? Credit products. So today, what the Islamic really products in a nutshell is a credit risk instrument. So the only risk that we take as Islamic banks and financial institutions is a credit risk. So if you look at your, for example, leasing or ijara products, it's got nothing to do with the lease. If you look at the morabah instruments, it's got nothing to do with the risk of underlying instruments. If you look at the musharaka or mudaraba projects, again, there's nothing about the real risk sharing. So everything basically is around the credit risk. So and
Is what?
Is around the credit risk. So and if you look at the Islamic finance, it is a very small part of the huge integrated debt market, global debt market. So and the debt market in today's finance is all about the interest rate angle of money and the compound interest. So the other point is that Islamic banking is in a direct competition with the conventional banking, which only looks at the credit risk. So at the end of the day, you would still be finding that the Islamic banks are gravitating towards the interest rate as a benchmark. Why? Two reasons. Because again, Islamic banks today, they take only the credit risk instead of other risks, which a classical Islamic contract should be taken. And the second is Islamic banking today is a small part of the much bigger debt market and capital market. So how, in reality, how we can be different from the conventional and still survive and still compete and still prosper? So that's the question.
Thank you.
And the other question is, if you look at the prices, for example, right, we would see that in the price of the commodities, a big chunk, depending on how capital intensive it is, the role of interest expense. So interest element of the cost is quite significant, depending on the interest. And final point is that even inflation is very much driven by the interest rate, i.e. the interest rate in the economy drives the inflation. So both the inflation and interest rate are inextricably related to each other.
Thank you. I will take one question from Mr. Yusri and later on, but I'm just mentioning it.
So that will be the
there are
last
already so
round.
many questions that has come up, so whether someone can answer the relevant question, then we'll take them.
Okay. What are the alternatives? There are many alternatives. Overnight rate somewhere in the US and so on. So these alternatives, from Islamic point of view, we are not free. We are still there is still an issue. However, these alternatives are transaction based, and then you have this issue of it's backward looking, it's not forward looking. It is centralized. It's market. You are using the market rate, but then the rate is not the same for everyone. It depends on the. So it's not clear from purely technical and financial point of view that these alternatives would solve the fundamental problems with the LIBOR. In any case, banks will move. They have to find a benchmark somehow, and they have to have an index or an indicator. So, in my opinion, this tailored benchmark, so to speak, if it is done on a blockchain basis, it will help everyone. It's not for Islamic banks only. It's for Islamic and conventional. This is a very valuable benchmark or economic indicator that is very important to everyone in the economy. This is, as far as we can tell, this benchmark as such is missing. The underlying components are there. The underlying are there. It's not that something we from scratch. No, it's not from scratch. It is there. The components are there. All we have to do is just to make it systematic, transparent, more frequent, and so on. That's the only thing. It is very valuable, very important. Now, we are not saying people will never use the whatever interest indicator. I mean, what we are saying is that financiers, they must be aware of their pricing decision. Again, if the expected inflation says it is 3% and you are financing at 2%, you are losing. You want to lose, it's up to you. I mean, that's up to them. but they must be aware. Currently, there is no systematic way to be aware. There is no systematic benchmark saying expected inflation is X, so that you can say, hey, why am I financing at less than X? There is no systematic way to tell. So all what we need, all what we are suggesting, make these important variables available. And people ultimately will converge to it. I'll come to the question of Brother Handamir. Now for investors, this is for credit instruments. If you want to establish a blockchain company, for example, how would you calculate the target internal rate of return? What is the hurdle rate or whatever? You calculate based on the sector, on the internal rate of return of companies in that sector. You don't worry about interest at all. So if you are equity investor, you don't worry about credit issues. The problem of interest arises mainly with credit financing. If you are credit financing, then you need to look into that. If not, then it's a different story. You will use an alternative benchmark. That would be internal rate of return of that sector in particular. If you are investing in agriculture, if you are investing in health, you benchmark to that sector, to the rate of return of that sector. But if we are if we are financing, now, developing countries usually, emerging economies, they would grow at a rate. Well, here's the answer. Why the rate of the interest? Why interest in emerging economy? At least before this, before the crisis in Turkey, why did we have the crisis, the currency crisis in Turkey? Because they were borrowing in euro or in dollars, and the interest on the dollar was very small after the crisis, while interest in the Turkish economy is high. Why? Because the growth rate was high. So all those lenders funded these businesses in Turkey, hoping to get 5 or 6%, when actually the federal rate was 0 or 0.1 or 0.5%. So interest rate was high because the economy was growing up. So ultimately, it's the economy, the growth of the economy, that determines what is the expected return. So we are back to the same fundamentals, that the growth of the economy is a major component, of course, plus expected inflation. So it's what kind of investment are you talking about? And then if you are long-term, then you look at long-term data. So instead of monthly data, assuming there is monthly data, you don't worry about monthly data. You take annual data if you are really long-term. If you are long-term in the sense of 3 years, for example, then you have to take, let's say, monthly or quarterly data and so on. So it depends on your position. Credit risk, there's something very important to point out here. Banks, they know how to calculate their costs, operational costs, overhead costs, and so on. Banks, they know how to calculate credit risk. And if I am good risk, the bank will give me that rate. If I'm bad risk, the bank will give me another rate. So banks, in principle, they can calculate that credit risk. What is at issue is the base rate. See, the premium is on top of the base rate, right? So the banks can calculate their premiums. That's not a big deal for banks. Whatever strategy they follow, they can do it. That's not an issue. The issue is the base rate. On top of what you are adding your own cost of operation, your client's credit risk, and so on. So the base rate is what we are looking for. So this benchmark is for the base rate, not for the premium. And this would take us to the second point, which is how to compete with banks. Well, banks have different rates, even conventional banks. If you go, I mean, that's a fact, right? Why? Because each bank has its own premium. They calculate their own cost, they calculate their own exposure, etc. So banks, they don't have exactly the same rate. Let me give you a story. When Al-Rajhi Bank started here in Saudi Arabia in roughly 89, something like that, they said, we calculate the markup on the principal. Okay, it's not on the balance. No, they said, okay, You want to buy a car, this car costs 50,000 riyals. We charge you 5% per annum. So 5 years, let's say. So 5% of 50,000 times 5. This is the markup divided by the number of years, by number of months, and that's it. And so many people say, hey, this is too much. You should calculate the markup based on the balance as the conventional financing approach. Rajhi never cared. The demand was so much for Islamic banking, and people are willing to pay. So what happened? Conventional banks adopted the same strategy. In Saudi Arabia, they gave up this calculating interest on the balance, and they started calculating on the principal. It's more profitable, and everyone is happy with it, so let's move. See? So it depends. So again, what we are saying is that this is not a way to calculate the price. No, this is a benchmark. This is something you say, okay, I will follow whatever formula provided to me by the finance department or by the treasury or whoever, but then I want to see how far my price is from the benchmark. How far from the expected inflation, how far from the growth of the economy. It's a benchmark. But because this benchmark is based on fundamentals, then we think that over time, banks and other financiers will converge toward these fundamentals. I think that would make it.
Thank you very much. There was one question from here.
My name is Yusuf from Global Partnership and Resource Organization. Thank you, Dr. Sami. This is a very sought after session, I think, for all of us. Seeing the crowd, that's why so many people come to your session. Very good session. Again, I recognize the session today we are talking about benchmark. We are not talking about the validity of interest rate as far as the system is concerned as a whole. So we need to find a good benchmark where we can really place Islamic finance in certain space as compared to conventional. And from your introduction, you mentioned about the downfall of LIBOR because of lack of trust. So there's a main reason for the downfall of LIBOR. And you mentioned about the possible alternative for that. We're talking about formula of the element of GDP could be one of the the equation for the new formula for the new proposed benchmark. And you mentioned about the component of blockchain is very important. So that's really a game changer for this discussion. My question, yes, blockchain, so we need to have a mechanic where we can really resolve the lack of trust we are facing now. But again, the question, how we really put the trust on blockchain, because we need to entice people to come in, and you mentioned about coins. Coins, you just matter to bring a retail or consumer respondent, but how about the big players like a big bank? Because as we all know, when we talk about GDP assessment by different big banks, they give a lot of differences on GDP for the country, for example. So again, we're talking about reliability of the big bank to come in, and how we can combine all the prominent players in blockchain, so that we can say that, look, blockchain is reliable, and then we can have a really reliable benchmark for alternative for LIBOR. Thank you.
Thank you very much. And once again, Dr. Sami, thank you very much for this presentation. Very, very quickly, I'll start by one aspect of characteristic in the LIBOR, and I hope it will disappear with the new benchmark we propose, which is the opportunity cost. And even Sharia-wise, that's one of the areas where scholars are focusing. Because what's LIBOR if you are asking me to finance your transaction, you have to give me more of what I can get easily from another bank. The interbank is offering me LIBOR. You have to offer me a spread above it. But in the same time, I said it's a positive side, but in the same time, I'm asking about the interbank transactions. How are these banks going to deal in themselves, especially in liquidity management, based on this benchmark? if we can extend this or expand it. I know many years ago I asked the question about monetary policy, but I know it's something that it is probably not needed now, but we have also to think how the central banks are going to use this benchmark. And especially, probably, in addition to these two factors, they again have to add that adjustment factor you put in the model, so that depending on their responsibility as policymaker, they have to adjust whether uploading or. The second point is, I would like to have your thoughts about some also doubts of circularity. You have been very clear that in some other alternatives, there is always on a circular way that the interest is there. When the surveys are going to come up with these estimation of expected growth, of quantities or volume, or what you call the GDP growth, and also the estimates of their expected prices, just to estimate the inflation, it's always an element of hidden interest, because these sectors are not strictly using this Islamic benchmark. They are also dealing with interest. And especially when the question was asked about the alternative for the LIBOR itself, we know and we do explain again for the audience that even the new alternatives are interest-based. So it's not going to be the LIBOR as per the current methodology, but differently. However, it will remain an interest-based kind of alternative. So the consequence is that because in the national economy, many companies and corporates in different sectors will still use interest to deal with, this estimation is going to bring the LIBOR somehow in their estimation. And this is for inflation as well as for the this is national level. Also international level, you know that no country is living in silos. You have bilateral financing, you have multilateral, you have the government also going into international loans and so on. That's the challenge for the model, and I hope, Dr. Sami, if you have some elaboration, but what I mean here, these are aspects to fine-tune the model for good implementation in the future. Thank you.
One question from the stage.
Thank you, Dr. Sami, again for this great presentation and presence, mashallah, and there's a lot of participation. My question is more related to blockchain. You mentioned about blockchain will be used like kind of tool to enhance the way we will be getting some accurate data and to maximize facts. I mean, data among different segments. But if you can just elaborate about, because there is this validation of the data, because how blockchain could really validate and make sure that what we are collecting is still accurate. Thank you.
If there are any questions, because this might be the last one.
Thank you very much, Dr. Sami. Really interesting presentation. I've got a rather simple question. You know, looking at the benchmarks such as this, I think there are 2 or 3 desirable qualities. One is, well, it has to be simple and understandable, but secondly is its acceptability. Now, from what you've seen on your research and interaction with others who are looking for a desirable benchmark, I mean, 2021 is right around the corner. How do you see this as something that would be acceptable to the industry? Or is this just so that it isn't an exercise in futility? Do you think this is something that would be acceptable by the industry, and do you see it gravitating towards that?
Assalamu alaikum, this is Professor. My question is, okay, from very beginning, given this Islamic finance, very small component of the whole system, what did we have come up with benchmark rate? Finally, this rate have to converge with the conventional part, because we are in global village. So what's the basic point for us to try so much to develop a benchmark which finally have to converge with someone else. In that case, someone else will have more sophisticated information, technology, we can come up with in a better way. So does it work practically for us to try so hard to find a benchmark which still have to converge with commercial market? Thank you.
Jazakallah khair. To make it very fast, is it possible to consider zakat as part of the formula? Because it's the only thing that's it's not human, so there is no mistake on that. Thank you.
Okay, this point has been raised frequently. Islamic finance is only a small segment of the global finance. Are we going to change the world and so on? Let me tell you something. In 2008, when the crisis hit, everyone was talking about Islamic finance. And they were very much, impressed by the idea that finance or financial institutions must serve the real economy. They said this over and over again. Mark Carney, for example, who is now the governor of the Bank of England, at the time he was governor of Bank of Canada and the chairman of Financial Stability Board. In the Financial Times interview, I think 2012, said the financial sector must, or banks must serve the real economy. So it's the power of ideas that change the world. It's not how much, what's your size? Are you big enough? No, that's not the only way to change the world. Ideas will change the world. So what we are saying to the world, look, you cannot ignore the real economy. Ultimately, wealth is generated from the real economy. Whatever returns you are making in this financial institution, the financial sector, it comes from the real economy. We're not saying drop all interest indicators. We are saying you must be aware of this benchmark. This benchmark must be somewhere there. Now, how far, how close they are, that's a different story. But this benchmark must be there. It is missing. And when we are saying it is missing, it's not that the component itself. The components are there. The concept is there. The idea is there. All we have to do is simply, as we said, reformulate it, make it more systematic, more reliable, more frequent, and so on. And that would be an idea that could help the world. We should be, we will not change the world by ourselves. We will never. I'm not sure, maybe. But that's not our strength. Our strength is not our size. I think our strength is the ideas that we are. That's why we have to formulate our ideas in a language that's acceptable to everyone, that's the acceptability issue. If we say this is Sharia compliant, this is not Sharia compliant, then people will say, okay, this is yours. We have nothing to do with this. Sharia is something belonging to you. We have nothing to do with Sharia. If we formulate our argument on rational, economic, sound reason, people have some reason to accept that argument. And that's, I think, what we should do. We should formulate our position in a language that is acceptable to everyone. So the ideas that make a difference, not the size. Okay, Jimmy, jump in. Okay. So I think this would answer many questions because Brother Lotfi, he raised about the interaction with interest. True, it is there. We are not saying it is not there. But at least the approach itself is independent. We are surveying the expectation, and expectation mostly are linked to the real economy, on the volume, on the prices. It is true, it is impacted by the financing, of course. But at least in principle, it is not, dependent on interest. Fine-tuning, I perfectly agree. There is so much work to do. I'm not saying this network or this platform is simple. No, it's not simple. It's not simple. The ideas are simple. The ideas are already there, established. But to convert these ideas into a workable network, reliable, I don't think that's very easy, and this will take us to the question on the blockchain and how to use the blockchain. There are many ways to use it. First of all, the identity, to validate the identity of the members of the network. If I log in and say, I am Hilal Hussein, then very easily Salah can say, hey, you are not Hilal Hussein, you are Sami Suhail. You cannot, so validating the identity, this is a well-established part of the blockchain, how to use the blockchain to validate the identity of the members of the group. How to validate the reporting, that actually this number is the number that I am offering, and then compare this number to other estimates from other members. Let me tell you something. There are betting markets on various things. Okay, artificial market. They would say, for example, in the election, there is a market on the election. So people would bet who's gonna win the election. And from the price of who gonna bet for and against, they calculate the probability that, well, this candidate is more likely to win or not. I think in Iowa, in Iowa, I think in Iowa they have electronic market for something like that. So they develop a betting market to discover. But betting, of course, is not the most reliable way to discover the underlying, factors, because betting, I'm playing a zero-sum game. My primary objective is to beat the other guy, not to discover what is going on. So the incentives are not aligned. So you end up with a distorted mechanism. It might work. We are not saying it has zero value, but the value is not what we are looking for. So instead of doing that, we could have this network, and we could have this prize of coin that would be offered to those participants to incentivize them. This will be part of the cost of the network. So these coins will be part of the cost of the network. And there are many ways. We are not saying it's simple or trivial. No, this is something that needs to be worked on. Zakah, actually, the first version that I shared with my colleagues, it included zakah. Zakah would be the benchmark for the real zakah. But it's a normative benchmark instead of, which is fixed and normal. But if we want to have actual positive, which means linked to the actual performance of the economy, then we follow this approach. So zakah is there, but I realize it will distort the attention towards something based on Sharia, so it will not be universal. So we need to have something that is acceptable. And then Muslim investors, they say, okay, I have to calculate the zakah. This is either part of my cost, or this would be the target. You see the policy component, there is a target output, target growth rate. You could say the target growth rate should be 2.5% based on zakah. But that's a policy variable. It's not an actual or positive value. It's a policy normative aspect. So that's why we did not mention that. Okay, thank you very much. This was very interesting, very useful.
Can we take another round of 2 more questions?
It's up to you.
We have 10 minutes. Any other questions?
Thank you very much. I like the argument about the power of ideas. So, my question is,
can you introduce yourself?
My name is Warren's friend.
And you are Jamil That will be easily verified.
Yeah, it was quite moving, and it brought it reminded me of something that has been bothering me, which I wanted to ask, which is, how do you see the role of interdisciplinary research?
Of what?
Interdisciplinary research in moving these powerful ideas forward. From what I'm seeing, it's like research of Islamic finance is going one way, somewhat traditional, and then you have a pool of expertise that Islamic finance can draw from in order to move this powerful idea that can go on forward. So, as a man of ideas, what do you think about this?
You don't have to answer today.
again, I am coming in again. I noticed that in your lecture, it's you're using the word universally acceptable. Universally acceptable, and the word Sharia compliant is like. My understanding is we should try to avoid it. I'm not sure if that's what you mean. But in, again, this question is Islamic finance. It is not that Sharia compliance is the fundamental of Islamic finance. Thank you.
One more question from this.
Assalamu alaikum. My name is Yusuf Al-Sawadi and I'm in the Awqaf Properties Investment Fund. My question is, can't we use, I assume that the world might converge to something in place of fiber. This is, might or might not be the case, but I assume that at some point they might. Couldn't the concept, so back to the power of ideas, couldn't we add the concept of adjusting that rate, whatever it is, to be closer to the real economy, which would require like a geographically specific adjustment, for example. So couldn't this be like, to some extent, our addition as Islamic finance is to correct the new LIBOR, let's say, on a geographically specific basis? Thank you.
One more last question.
This is still we're asking about the LIBOR. For example, do we have like the alternative is not yet ready, and the 2021 is around the corner. And how the Islamic Bank are intending to do, and in precise terms, for example, in IDB, every transaction is based on LIBOR. Do you have an idea that what will be the policy in IDB?
First of all, as far as I know, IDB does not use the LIBOR, right? It is the 5-year swap rate, something like that. So, but here is the point is that for commodity مرابحة, yes, commodity مرابحة, but for sukuk, it's 5-year swap rate. Yes, okay. When installment sale, you are using LIBOR, not the forward 5-year swap rate. Okay. So IDB has to find an alternative. Okay?
So you get your first customer.
How to do interdisciplinary research? That's a very important question. And I agree, we are limited. We are in silos. We tend to say, oh, no, this is Islamic. This is not pure economics. Why are you talking about this is economic? We are talking about Islamic economics. Or this is finance. We are talking about Islamic finance. So that's maybe one reason why I'm trying to avoid using the word Sharia compliant or Islamic. It is not because we are shy of our principles. It's exactly the opposite. It is because we are so confident in these principles that we think these principles will speak for themselves. The moment you set these principles, you explain them, they will prove themselves. You don't have to say I'm a Muslim or this is Islam. The moment you say finance has to be integrated with the real economy, this by itself proves itself. It stands by itself. You don't have to say it is in the Quran. We don't have to. But we are not shy of saying that it is in the Quran. Of course, we are not shy of that. Christine Lagarde, in 2012, I think, or 2009, when she was the Minister of Finance in France, she made a statement. She said, the principles that we are fighting for are well inscribed in Islamic finance. And this was reported by France 24, which is a French news agency. You can search it by yourself. There is no reason that we should shine. No, we are not. But our arguments must rely on common understanding, rational reasoning, and so on. We are not saying we will change the Sharia to fit what we think is rational. No. That's the tricky part. So we are just saying we want to prove ourselves. If we want to take out the borders, with others, then we have to lower the bar. We say, okay, let's start talking economics. Is this sound economic principle? Are these sound economic principles? Is this reasonable? Is this transparent? Is it verifiable? Does it create wealth? Does it create jobs? Does it promote economic development? And so on. And these are the common objectives. That's the maqasid al-sharia. Maqasid al-sharia talks about how to make life better for everyone. وَمَا أَرْسَلْنَاكَ إِلَّا رَحْمَةً لِلْعَالَمِينَ, for everyone. Even for non-Muslims. Islam would be rahmah even for those who are, just like we say about alcohol. Alcohol is bad. It doesn't matter whether this society is Muslim or not. Even if they are not Muslim, we are telling them alcohol is bad. And everyone knows this anyway. But the point is that to prove that alcohol is bad, you don't have to be a Muslim to prove it. You simply, it is clear. It is a well-formulated argument. So we're not shy of saying Sharia compliant or Islamic, but we don't want to create a wall that say, oh no, this is Islamic. So as if once you put this wall, we can do anything inside. And the bad result of this, or the unfortunate result of that, is that we start doing exactly what the conventional are doing, simply because we have a label that's called Islamic. If we take out this label, what do we find? Do you find a different product or exactly the same product? These are the questions that we have to address head on. We shouldn't be shy of this. Are we providing something different, really different? Are we adding value to the world? Or we are simply replicating or imitating what the world is doing in a more complicated way? And then we are giving it a religious, people will laugh at us. Say, you are doing exactly what we are doing, and you are saying this is religious. Religion is supposed to make life better. So how to make life better for people? Geographically, interest is geographically different, by the way, remember. So you will have, for example, you will have every central bank, they have their own rate. In the same even in the same region, in the Gulf region, South Asia region, each central bank, they have their own rate.
My point was to correct whatever is like
This is true.
closer to the real
This is true. We have to correct it for the real economy. That's true.
And that this correction would be, identify that.
Could be geographically, could be if you aggregate, because still if you aggregate the data, you can say world GDP is expected to grow at X. If you are a multinational company, then you start looking at global expectations. But geographically, it is already there. So those, in many cases, people say, how would you develop a different indicator? That means there will be arbitrage between this indicator and the Islamic indicator, or between interest. It is already different. Even interest rates are not the same. They are different across countries, even banks will have different rates. LIBOR itself is an average. LIBOR itself is a trimmed average. They take the upper, let's say 10%, the bottom 10%, and the remaining they take the average. So LIBOR itself is an average, which means not everyone in this panel of interbank rate, they are using the same rate of LIBOR. The fact that it is an average means not every bank is using that rate. So even the banks who are reporting their rates from which LIBOR is derived, they are not using LIBOR. So why we have to stick to that? Ultimately, each bank will have its own views. But as you said, we want the real economy to have an impact. We want the financial sector to gravitate toward the real economy. And this will help, at least in the long run, inshallah, to optimize the value of the financial sector. Thank you very much.
Thank you very much. Thank you very much, Dr. Sami, and thank you for all of you who joined. Lastly, I would like to mention two things.
Can we maybe, if you want, with public? Yes.
Okay, make a comment, then I will conclude later.
Can you just introduce yourself? Sure.
Dr. Omar Fisher, advisor to Ayman Sijini at ICD. And just a quick observation, apologize for coming late, I was in a conference. It seems to me that there needs to be a sense of urgency in this whole discussion. Why is that? Because if we look at the Bank of International Settlements, it's clear that derivatives and different type of financial instruments on the debt side are dominating the financial sector. So what level? $720 trillion. The GDP per cap of the whole world is roughly about 80 trillion. So we have paper transactions on the debt side which have a magnitude of about an 8x already. We are poised, I believe, I'm not predicting, Allah knows best, we're poised to enter an era of a second global recession. Pretty obvious, a number of the red flags are there. When it happens, it's again up to a lot of circumstances. But that means, I believe, that the area we hold dear and where we have extensive experience is in asset-backed financing and in sale transactions, which of course predate by several hundred, if not 1,000 years, the conventional financing. And I believe maybe part of the way forward has been suggested is in the naming, is in the nomenclature we use. So we go back to the power of Adam, peace be upon him. Part of his strength, of which we're all derivatives, right? But in a positive, healthy sense, is in naming. Allah subhanahu wa ta'ala gave us the power to name things. And by naming it, you not only have some measure of control, but also it opens up the possibility of broader communication. So I don't have a solution, but I'm just giving some observations for us to think about. I wrote a paper a couple of years ago where I hatched the idea of purple capital. So if we focus on the transactions and the basis of the transactions, but possibly leave to one side, as I heard was suggested, the religious views and practices. Of course, the transactions themselves are imbued with our glorious Islamic values, but that will speak for itself. And so, in conclusion, I would just ask you to give some thought to the urgency of this whole topic. Getting back to encouraging and promulgating asset-backed transactions. Because in conclusion, I will remind us all that the Islamic funds and asset-backed transactions in the last global recession, the documentation, the research is very clear, outperformed the conventional precisely because they were not using leverage and because there was more confidence and trust in asset-backed kind of financing.
Thank you, Mr. Fisher. I'm sorry I didn't recognize you have changed so much that I looked at who is when you entered, like somebody had entered, but I didn't recognize you at that time.
I think we would like you to be part of this COP. You have to be member now by force. So this is, again, sorry, I don't want to say more things, but just please, we're going to send you a survey just to register to become member of the COP. So please, just, this is voluntary based, but it's very important to share your brand, share your ideas, leverage from your experience, and make it, it was a wonderful discussion today. We need to take it to the next level, inshallah. Thank you so much again, and thanks for Dr. Sami and another club for